Have you ever wondered how rising inflation and economic growth impact markets like the US dollar, gold, and the S&P 500? Today, we'll break it down with real data and show you how these key factors shape financial markets. Stick around, and by the end of this video, you'll have a solid understanding of what's happening right now and how to position yourself for what's next. Let's dive in. First, let's talk about inflation. Simply put, inflation is the rate at which prices for goods and services increase over time. It's measured by key indicators like the Consumer Price Index, CPI, and Core PCE, which track changes in prices across the economy. Moderate inflation is healthy. It means the economy is growing. But when inflation gets too high, it starts to erode your purchasing power. For example, if inflation rises 5%, your $100 today will only buy you $95 worth of goods next year. That's why central banks, like the Federal Reserve, closely monitor inflation and adjust interest rates to keep it under control. Now, let's define economic growth. Growth refers to the increase in the production of goods and services over time, usually measured by gross domestic product, GDP. When the economy grows, we see more jobs, higher incomes, and increased consumer spending, all of which boost business profits. Key indicators of economic growth include the GDP growth rate, PMI, Purchasing Managers Index, for manufacturing and services, retail sales, and employment data. When these indicators are strong, it means the economy is expanding. But if they weaken, it could signal an economic slowdown. Now that we understand inflation and growth, let's explore 4 possible scenarios and how they impact financial markets. 1. Rising growth plus rising inflation. In this scenario, the economy is expanding, but rising prices could force central banks to raise interest rates to cool inflation. DXY, US dollar, bullish. Higher rates attract foreign capital. Gold, bearish in the short term due to higher real rates. S&P 500, mixed. Growth-sensitive sectors like energy perform well, but tech stocks may struggle. 2. Falling growth plus falling inflation. This is often seen in recessions. Consumer demand is shrinking, and both growth and inflation are falling. DXY, weak. Gold, bullish as a safe haven asset. S&P 500, bearish due to declining corporate earnings. 3. Rising growth plus falling inflation. This is the best case scenario. The economy is growing while prices remain stable. DXY, neutral or strong. Gold, bearish. S&P 500, bullish across most sectors. 4. Falling growth plus. Rising inflation, stagflation. This is the worst case scenario, economic stagnation combined with high inflation. DXY, mixed. Gold, bullish. S&P 500, bearish, especially for rate-sensitive sectors. Now let's look at the current data and what it tells us about the economy. GDP, 2.3%, moderate growth. Manufacturing, PMI, 50.9, still expanding. Services, PMI, 52.8, solid growth in the services sector. CPI MOM, 0.5%. Inflation is picking up again. Core CPI MOM, 0.4%. Underlying inflation remains sticky. NFP with revisions, strong job market with upward revisions to 307,000 jobs. This combination of rising growth and rising inflation means the Fed will likely maintain its hawkish stance. The US dollar is strengthening. Gold could remain under pressure in the short term, and the S&P 500 may see some choppy moves, especially in tech and rate-sensitive sectors. In summary, we're currently experiencing rising growth and rising inflation. This creates both risks and opportunities for traders and investors. Watch Fed policy closely for rate decisions. Focus on growth-sensitive sectors like energy and financials. Consider gold as a medium-term inflation hedge. If you want more updates and insights like this, don't forget to like, subscribe, and turn on notifications.